welcome to another episode of the Rocket Your Dollar podcast. And I'm excited to actually talk to Keshav's partner a while back. So I know a little bit about Clive Capital, but I want to have him tell us not just about Clive Capital itself, but sort of his role. And I think that they serve a very unique community that aligns a lot with the Rocket Dollar community. So these are, high income W-2 tech employees who are looking at expanding income streams and achieving financial freedom. And I really like that because you guys talk a lot about that. But maybe I'll let Keshav introduce himself and the firm. So just tell us a little bit about yourself, like where you're from, where you're based, professional and personal background, because they're kind of tied together. Let our audience
Sure
know.
thing. Yeah. Thank you for having me on the show today, Henry. Glad to be here. And thanks to those listening at home. So, yeah, my name is Keshav Kolur, founder and principal of Clive Capital. And I'm based out of New York City. Grew up in Boston and Providence, Rhode Island. Boston being in Massachusetts, but that's a much more well-known city than Providence is. Hence, I'd had the state. Anyway, I grew up and then, went to college to be a mechanical engineer. Original goal was to get into robotics, and now we're kind of starting to see that you really pick up that field. But 10 years ago, I think it was really in the early stages still. Coming out of college, I just knew that I didn't want to work for someone else. I didn't want to have to work for someone else for the rest of my life. I wanted work optionality, financial freedom.
Got it.
And so I realized that I didn't want to rely on someone else for just one paycheck. And just seeing my parents growing up, all they knew was investing in the stock market. And I saw how well that did for them in terms of the ups and downs growing up during the 2008 financial crisis. Just didn't have much trust in the stock market. I wanted investments that I controlled that weren't just left to the whim of tweets and wars and things like that. So I became a realtor when I graduated college 2019, 7 years ago. Original goal was to buy a single family rental real estate portfolio. Then, luckily, before I went too far down that path, one of my best friends from college told me about syndications, which is what we do now, where investors can invest typically as little as $50,000. That's a privileged statement, I know, but it is a lot more accessible than a lot of people think it is to invest into big apartment buildings, oil and gas wells, various types of like other initiatives in business and
Right.
energy, real estate, etc., private lending. And to me, this sounded a lot better because the returns were better than the stock market. The passive income is better than the dividends you find in the stock market. The tax benefits are better. And it's just diversification, not having all of your eggs in one basket. So I made my first investment into an 108 unit apartment building in San Antonio, Texas, 4 years
Okay.
ago. Started seeing the passive income coming in from that. And at that point, it was a proof of concept to me that, hey, this works and this is how I'm going to manage my wealth. And I want to do the same for my friends and family, coworkers, anyone else who's interested. So I founded Clive Capital January of 2022. Our goal is to help primarily tech professionals because that's my background, but other
Sure.
high earners as well invest into these alternative investments to achieve generational wealth, passive income, financial freedom, tax savings, things like that. So we're approaching the $10 million mark in investor capital, which is a big milestone
Wow.
for us. Yeah. And that's allocated across 1,100 apartment units. Not saying we own all of it, but that's just what we've diversified into 1,100 apartment units, 100 single family rental homes, 47 oil and gas wells, 14 industrial warehouses, and private lending nationwide. And our kind of larger than life goal, this investments is just the chapter one of it, but the larger than life is just to be your one stop shop for all wealth management and financial needs from not only investments, but tax planning, retirement planning, estate planning, things like that. And eventually to be able to help 10,000 families achieve financial independence.
I see. Now, I want to go back because I imagine that given your background, you were kind of on a track to go into tech. You graduated with that and becoming a realtor. I mean, most people they're kind of loosely interested in real estate, but they don't actually go get a real estate license
Yeah.
and so forth. And it sounds like you didn't do that too long before getting into getting into the syndications. But when you made your first investment, like how did you find that syndication? Because this sounds like it predated Clive Capital itself.
Yeah.
Did you get contacted by a friend of a friend who was pulling together money for this 108 unit complex in San Antonio?
Yeah, sure thing. Yeah, at the time I had just moved to New York City, and so I first learned about syndications in 2020, and that's when my friend sent me a Reddit thread about
Okay.
syndications. So some guy was talking about how he was a tech executive and he, at his peak, owned 40 single family homes and switched over to investing into apartment buildings and how that's more scalable, less of a headache, and more profitable as well. And so that's when that bell kind of rang in my head that, hey, everything this guy, is saying makes sense. And I think it's
Yeah.
good for me to just kind of skip that entire first chapter of rental real estate and just jump straight into syndications. And so I just reached out to him, the guy who made the post on Reddit. And
Yeah.
this was during COVID. And so no one could go anywhere, do in-person meetups, which was kind of fortunate for me because I now didn't have to go to a conference or pay some ticket. It was just Zoom rooms all day long.
Yeah.
And so this guy hosted Zoom meetups, and then I met people from those Zoom meetups. They hosted their own Zoom meetups. So it just kind of kept branching out from there. Eventually
Okay.
invested into that guy's first syndication, the author of that Reddit post.
Ah, got it. Okay. All right.
Yeah.
So, maybe similar. I mean, it sounds like obviously, Clive Capital, you've since started that particular entity, but I was just kind of curious, but maybe you could talk, kind of help the audience understand just, is that sort of the way you viewed it, which was that, hey, I have, funds sitting there and I could invest in my 401k or the stock market. That's obviously pretty accessible for folks at any dollar amount, whether that's someone sitting on a few $100,000, $50,000, or even just getting started in investments. But how do you expand beyond that, right? You said it was kind of a privileged statement that at Clive Capital you accept $50,000 minimums, which for cash lying around may be difficult. But if you're, let's say, 10, 15 years into a W-2 career in the technology industry or a professional services firm like management consulting, lawyer, accounting, something like that, that's not a relatively large amount. It's basically probably taking some 401k and match chips off the table to then diversify, as you mentioned before, going into just something that maybe isn't subject to the whims of the stock market, right? So, I'm just curious about how Clive Capital, like, how do you go find these deals that you now want to syndicate, and how is it structured? I mean, do you guys invest, run this deal, and then you have an entire structure set up and you put in your own capital and then you go and supplement that with investor capital? I asked a lot of questions there, but I'll let you kind of explain.
Yeah. Yeah, you're good. So we find our opportunities primarily through our networks. I used to be a part of various networking groups, paid networking groups, where I built a network of people who are primarily in the real estate space, but other people were raising capital and doing deals in other spaces as well, in private lending, in oil and gas, and I
Okay.
think the craziest one I've heard is people syndicating MLS soccer teams here in the US, if I remember correctly. And
Okay.
so from there, it was a matter of figuring out which asset classes I wanted to get into. And so when we started out originally, it was going after a lot of the big names in the industry and seeing if we could invest with them. And their returns were standard 15, 16% internal rate of return multifamily value add deals.
Yeah.
And that's how we started. And I was also involved with a development group. So I was on the team for a couple of development deals as well. And I just realized that at the pace the stock market was growing 2, 3 years ago, just that boom after COVID, that
Sure.
15, 16% didn't mean anything to people because they were
Oh, okay.
hitting that in the stock market. Now, I'm not
Yeah.
saying that that's the right way to look at it because that could drop, anytime, right? And we're seeing that there's a lot of fear and uncertainty in the market. But I just realized that like I have to go out there and find even better investments. The 15 to 16% is not cutting it, especially a lot of our investor base is in technology. So they work at Meta, Amazon, Google, Tesla. Their returns are even higher because of this
Yeah.
AI
Yeah.
boom. So I have
Yeah.
to match, or at least do my best to come close to it, right? So we started finding opportunities that with companies that weren't as well advertised, and those really came primarily through network because some of these deals are not even advertised. Some of the best deals happen behind closed doors where just a couple of big investors will come in and fill in the entire capital stack themselves. That's one. And then two, like specifically getting into oil and gas, for example. The reason I wanted to get into that is because I knew there was a lot of great W-2 tax benefits there. And so for me, I wanted to find someone who understood the space, who had experience in the space, because oil and gas, especially, is very susceptible to scam artists. A lot of people in that industry, because it's even less well understood than real estate, unfortunately take advantage of investors, especially by kind of dangling that shiny carrot or whatever carrot you want to call of tax benefits, right? And so they take advantage of people that way. And so for that, I went through my network as well to find my partner who I work with now on the oil and gas deals. She's either second or third generation Texan, her and in oil and gas. So she was someone I knew I could partner with.
Okay. I see.
Yeah. And we primarily, moving on to the kinds of deals that we do, we're primarily a fund of funds management company. So we don't have any specific asset class that we focus on. Our goal is to go out there and find the best deals possible. And when we look at investments, we generally evaluate it from the lens of six criteria. So number one is returns. Number two is passive income. Number three is tax benefits. Number four is risk. Five is liquidity. And six is altruism/impact investing.
Okay.
And that's because just in my conversations with investors over the last 4 years, that's what I found a lot of people care about, right? And so we like to find investments that are lower returns, but maybe it's lower risk, right? And then some people, they want higher returns and they're willing to take on the higher risk. Some people just want pure passive income. So for them, the private lending works out great. Some people want tax benefits. And so no matter who you are, your investment criteria and your philosophy in general lies somewhere on that spectrum. So our goal is to find an investment that works for you, no matter who you are and what your investment philosophy or financial goals are.
Now, just so I understand, is Clive Capital just one particular fund you mentioned, or is it like project by project? Like people look and say, okay, this is an apartment complex, this is an oil and gas deal. I want to do this one. I don't want to do that one because different people may have different goals with their money. Like for example, if someone's coming in from a retirement account standpoint, maybe they're okay getting a steady income stream. They just don't need to actually receive it. They'd rather just have that kind of sit and accumulate inside the IRA. So they get a predictable income stream that they get the full benefit of to redeploy when the deal pays out. For example, like an apartment complex deal versus oil and gas. Are they specific, or is it just one big Clive Capital master fund?
No, it's specific. And that just again speaks to we want to be able to our goal is to obviously one, find the opportunities and network and do our due diligence with the best companies to invest into. But then on the other side is just educate investors and learn about their objectives and try to match the two in terms of, hey, this is your objective, this is the best investment that we have found out in the market,
Mhm.
the risk mitigated, meeting your goals, etc. So right now it's a deal by deal basis. So you get to
Okay.
pick and choose how and where exactly to allocate your dollars.
And do you have people that kind of just go across like multiple deals, like a lot of repeat investors that you find through your network, for example?
Yeah, definitely. A lot of them will, I think on average, folks are investing into 1.5 to 2, roughly 1.5 deals with us. And a lot of the growth has come in the last year, primarily into our oil and gas opportunities. But as we bring out more and more opportunities, they do want to diversify beyond because each investment really only solves at its best one problem.
Hmm.
So like the problem oil and gas primarily solves is taxation. It does have passive income, but primarily the reason people love it is taxation. Private lending, just straight passive income. And
Okay.
everyone typically has multiple goals, so people typically get into multiple investments as well.
Well, and let's kind of shift to like bigger, just because your perch as a kind of a someone who's has a good understanding of the private markets. I mean, I'm always kind of curious too that you mentioned that the stock market was doing really, really well after that sort of COVID boom. And, whether that sustains itself or not, that's not really germane to today's conversation. But, I am interested if you could share maybe some of your high level sort of views towards some of these asset classes like real estate, oil and gas, just or maybe even the viability or growth of private investments in general. Because I mean, this has been largely mega institution driven. You're now giving access to probably like the mass affluent retail investor into this, and if there were, I don't know, let's say 10,000 Clive Capitals that get created over the next 10 years. I mean, that's a lot of influx of new capital and money that would go into these private investments. And is it because more money will fuel better returns and better growth in that particular industry, or more money's coming there because the returns have always been there and now people are starting to, because of organizations like yours, start to have access to it in a more readily available way?
Yeah, so I think a lot of it has to do with regulations, and I believe sometime in the 1980s, there was a change that allowed previously capital raises were limited to $5 million, I believe, and then they took that limit off, and you could raise an unlimited amount of capital, but you couldn't advertise to everyone. I might be missing a few details here, but that's my
Yeah.
general recollection. Then in 2012 was the big revolution, really, with the Jobs Act, where syndications became popular because now, through the 506C offering, you are allowed to advertise and publicly solicit your deals, but you can only do so to accredited investors who meet minimum net worth or income requirements. So a lot of this growth that we've seen is because of those regulation changes, because now it's not just that you have to be a member at, a yacht club or a
Yeah.
country club, or your uncle has to know someone. As long as you're on the internet somewhere and you make enough money, these companies are targeting you. Like, I see Facebook ads and Instagram ads, and my investors do as well, for all of these services.
Mhm.
So I think that is the primary driving factor of why this is becoming more popular. I think over time, I would anticipate that returns would get lower. That's just what folks have told me in terms of real estate investing in the past versus now. It's just
Okay.
because there's a lot of new capital, a lot of dry powder chasing fewer and fewer opportunities, returns are compressing. And so that doesn't mean that the returns to me are still better than the stock market. Because at the end of the day, I don't really care about the vehicle as much as I do its ability to achieve the financial objectives that I want achieved, which are, again, are the six that I mentioned, right? Returns, passive income, tax benefits, etc.
Yeah.
I think over time, this market will continue to grow. And I feel like even some of the best companies today aren't being taken public because investors just want to stay private. That's where the returns are. That's where the more sophisticated investors play, and it just gives them more control, fewer regulations, and things like that. So,
I see.
yeah,
Well, and that
I
also,
see this only growing.
if the really, really big companies or the really high quality companies stay private, well, now people will have to go find that 20-year growth curve somewhere else, right? There is no Google going public in 1996 or Amazon going public in 1995.
Yeah,
For example, I mean, at the end of the day, maybe a lot of people didn't have the stomach to stay with these companies through the ups and downs in the early days. But had they done that, I mean, I'm guessing these companies are somewhere in the five-figure return percentage ranges by now, and they've made tremendous wealth. But a SpaceX and a OpenAI, for example, are already decent in terms of size. Like, I mean, they would debut in the top 10 in the S&P
right.
500 if they were to go public. So there is no, they start at number 4,000 as a public company and move up the ranks to eventually become one, two, three, four, five, six, or seven, like we see now. Right. So,
Exactly.
so people don't have the chance to ride that 20-year wave. They're going to have to go do something else to go get these, returns above and beyond historical returns of the stock market. So if that was, let's say, 8, 9, 10%, where are they going to get, 13, 14, 15 compounded CAGR growth, compound annual growth rate numbers?
Exactly. I wouldn't say I'm a pundit in the stock market by any means, but I do think, like you mentioned, increasingly either they're going to go public right off the bat because maybe they're very capital intensive industries. Like, I
Sure.
think there are a lot of robotics companies, space companies, energy companies out there that are going public, or they'll stay private for as long as they can, delay the inevitable if they're well funded, and
Hmm.
then at some point, go public. But if if they go public really early, it's you have great access for retail investors, but then again, the risk is higher because if the risk wasn't that high or the capex wasn't that high that was needed, they probably would have kept it private anyway.
I see. Okay. And I like that you focus on the I was reading an article just the other day that if you go from, let's say, single family rentals, so a lot of our audience, they access their retirement accounts, they unlock them using a Rocket Dollar account, and they may go get into real estate investing. Now, these are people that probably have one or two rental properties, but to access more capital to go do let's say a third or fourth deal, they decide that this third or fourth deal is more for the purpose of getting the deal and less for the tax benefits and depreciation that come with a single property. But the value of that investment long run is really dependent on the rest of the neighborhood. So, like, they're based on comparability analysis, whereas an apartment complex is basically a multifamily is determined by your quality of operating that
Correct.
investment. So, like, if you take over a 110 or 108 unit apartment complex in San Antonio and you're a better, more efficient operator, you're increasing the value of that investment regardless of the apartment complex next door to it, which is completely how it's tied. You could be a very efficient single family home operator, but it's going to be valued based on the homes left, right, and in front of you and behind you, and so forth, and the efficiency. So that just leads me to a question I have. But for our audience, and maybe this is just you now being a professional, full-time private investor running syndications, but less than a decade ago, you were working a technology W-2, only kind of doing that type of job. Like, what advice would you give to people in our audience if they were really starting to diversify? Or, like, do you have recommendations for how maybe you should allocate your overall investable portfolio between private, public, type investments? Do you have a guideline? You mentioned you work in a retirement planning firm, so maybe you have some opinions on that.
Yeah, yeah. So I would say and there's so many thoughts here that I'm trying to organize them in some sort of sequence that
Sure.
makes sense. I would say one, get started. That's the biggest one in terms of education, right? Get started in terms of education because the
Sure.
window of time, in my opinion, is closing, right? The window to make money is closing. The window to hold a job is closing because AI is coming for us all. We see, not to sound alarmist or doomsdayist or conspiracy theorists, whatever it is, but we're seeing a lot of companies do layoffs because their job functions are just being replaced by AI more and more. And so
Sure.
maybe may some people say that'll open up new opportunities like prompt engineering or AI safety. That could be the case. I'm not denying that. But I don't want to bank on the fact that AI will create more jobs than it will take away. Because in my opinion, could be wrong. I think it's going to take away more jobs than it will create. So if you don't have a job to create income or some business to create income, you can't invest or secure financial freedom for yourself. So number one is just getting ahead of it now because we don't know where we're going to be, like if money is even going to mean anything in 10 years and what that world looks like.
Sure.
Get started now. Let me just compress that all into
Sure.
one. And then second is start getting educated in terms of like attending local networking groups, right? Like real estate investor meetups or following people on LinkedIn, listening to podcasts like yours and mine, going onto people's websites, downloading educational resources. Like on our website, for example, we have a ebook called Investing, Why You Should Be Investing Outside the Stock Market. And that covers a lot of the basics of why it makes sense to do so.
Okay.
And once you have that base of education and a network, like, hey, these are the 10 companies that I'm interested in that I want to, invest into their next deal, start practicing analyzing deals. And don't do it alone, right? Get your spouse involved, get your friends involved, and really get educated that way. I think this is where a lot of people's journeys will stop. Like, short of not starting at all, is this
Sure.
stage where you have to pick an investment. And it's one that a lot of engineers and people in tech or STEM in general get caught up on in analysis paralysis. So there, I would say, move on 80% of the facts that you have because no one ever has 100% of the facts or certainty. All investments involve risk. Just make sure that whatever you invest, you won't be out on the street if that investment goes completely south and you lose
Got it.
everything. And from there, it's just about continuing to stay educated. Read the investor updates, right? Ask questions if you have it, expand into other asset classes. And I would say that that journey never stops. I continue to learn new things to this day about investment strategies, again, tax planning strategies, insurance strategies, all of these things.
I see.
And and so that's what I would tell folks at home.
Well, that's really helpful. Well, as we kind of come to the close here, you mentioned the book. Like, you want to share, like, where can people find out more information about you, your partner, and your company, and maybe even get access to that book, where to invest outside the stock market? So, where can people find you online?
Yeah, I would say LinkedIn's a great spot. So we post there every day, trying to get better about it, but educational
Okay,
content. Our YouTube channel, Investing for Generational Wealth, and our like slash podcast where we had you on as a speaker is a
sure.
great place as well. And then our website, clivecap.com, just has a lot of educational resources in terms of, yeah, why you should be investing outside the stock market, 111 questions to ask before you invest, the basics of oil and gas, all of these different topics.
Okay, that's perfect. I mean, and I'm just kind of thinking about how people are really starting to transition. And you mentioned that maybe investing in something other than the stock market is a diversification play, but it sounds like you're also telling people that, look, you have to expand your knowledge because you have to understand that your job itself may be uh, threatened by the comeuppance of AI, especially if you're in technology. So you need a different skill set. And what you're talking about is probably even producing a different income stream by becoming a knowledgeable investor in things that really aren't tied to the stock market, which for the most part, you don't control, right? It goes up and down. You said that even going back to the credit crisis days, I always start where, um, my parents came to America in the 70s. And I think back in that era, owning stock kind of was communicated as having an ownership stake and like a little bit of control in that company. And somewhere along the way, as this century started, that went away. Now it became a no control. You have no idea if it's going to go up or down. Maybe people day trade it if it's inside of a non-capital gains account. But really at the end of the day, I think what you're talking about is that you're going into things that are tangible, right? Like things that are needed. Shelters needed. Oil and gas are needed. And then I guess depending on where these things are, people can actually go see these particular projects or properties and so forth, which, you really can't go and see what Amazon is doing. You might see their trucks out and about, but you don't get a sense of what the whole company's doing, um, and so forth. But I think what you're sharing is really, really great and really giving access and tapping into a community of folks that not just invest in the stock market, but they work at these companies whose stocks are driving the returns of the overall stock market. So I think that part and parcel with your community, especially, maybe it's even more important for them to get into something that is the diametric opposite end of the spectrum, which could be a 108 unit apartment complex in San Antonio, Texas, which is about an hour away from where I live, and so forth. But I appreciate you coming on and sharing. So it's clivecap.com. You guys post on LinkedIn. Do they look for Clive Capital or do they look for you, Keshav?
For me, I would say.
Okay, so that's Keshav and then Kolur, Kelur, on LinkedIn.
Kolur.
Kolur. Sorry about that.
You're good.
Kolur. Um, to find more information about you, and then that book. And I was just thinking, 111 questions is a lot of questions to ask. If you ask 111 questions about an investment, you're going to know quite a bit
Exactly.
about it. And I'm not sure that people actually do that before deciding to hit a button and purchase a share of stock or an index fund in their account for
Yeah. Well,
sure.
I think now one of the great things with AI, one of the great, yeah, like it's a dual-edged sword. But one of the great things with AI is its ability to process information, large
Hmm.
swaths of it. So as long as you have the checklist, you have the materials you need from the operator in terms of pitch deck, underwriting, market reports, past
Sure.
performance, things like that. It's easier than it was before to kind of plug and play and see where the gaps are.
That's a fair statement for sure. Well, I appreciate you spending a little bit of time. I know you're super busy. It took a long time to kind of pin you down, even for 30 minutes to have a conversation. But I'm excited to be able to share with our community, because syndications are a route that a lot of people like. It's passive. It allows them to get into a more sophisticated deal. In a sense, they have to have a good understanding of the deal you're doing, but they don't have to have the knowledge of how to operate. That's what they're outsourcing to you. And that's where you make your money alongside your capitals inside the deal as well. So I think that's relevant. So at Clive Capital, is it roughly average ticket size, at least at the beginning, is 50,000? You mentioned that at the beginning, just so we know the
Yeah.
range.
For all of our investments except oil and gas, it's 50,000. Oil and gas, just because of the high demand, is 100,000.
100,000. Okay.
Yeah.
All right. Perfect. Well, we'll definitely tell people, put it in the show notes, and share the good word. But, I think that our audiences overlap. Appreciate you again taking 30 minutes. I know we even had to negotiate between different meeting rooms as well. So you're a busy, busy man there in the Northeast.
Yeah. Yeah.
But
I
thank you very
appreciate you
much.
taking the time to having me on here, Henry, as well.
Thank you for joining us for another episode of the Rocket Your Dollar podcast.